Okay, hello guys. Like I said from the previous video, that was the introduction video, right? It was the introduction video. So this video, I'm going to talk about the rules that we follow for ICC and CCT and why we even try to trade ICC and CCT. Okay. Now, if you know ICC is indication, correction, and continuation by this trader traced by side. Okay. And CCT is candle continuation theory. Candle continuation theory. Okay, so I will explain these two terms to you to understand the reason why we even use the terms, and I will also try to help you to understand the rules that you have to follow when you are trying to trade CCT so that you have the high probability trades. All right. So one thing that you have to understand is why we trade ICC. Let's start with ICC and what ICC even stands for. I'm going to give you a brief explanation on it because I don't want this video to be so long so that you can also jump into CCT and jump into the rules for CCT, and that will be the end for this video. Okay. Now ICC stands for indication, correction, and continuation. Indication, correction, and continuation. Like I said, this channel is not going to be about non-advanced stuff. The things that I'm going to talk about are a little bit advanced, so you shouldn't be a beginner. And if you're a beginner, I don't recommend this channel for you first. I recommend that you go to YouTube, you learn market structure, you learn a lot of different things, then you can come and you can continue with this advanced stuff. All right. So without wasting much time, let me show you how the market moves. We all know that the market moves in waves like this, right? It starts moving up like this. Now, what we already know from the trading industry is that when the market makes a wave, like you can see from here, the market moves from this place to this place and moved down and moved above this high again. So moving above this high in smart money concept, that is what they call break of structure, right? Or normal price action, language, we say higher high, lower high, higher high, lower high, higher high, lower high, higher high, right? And that is a bullish scenario, and the same thing applies for a bearish scenario. It just reverse the trend. Okay, so this one is just a bullish pattern, and this one is a higher high or a break of structure. Now what most people do is that they wait for the retracement from the tip of the higher high to this area is what you call the retracement, because the market doesn't move in a straight line. As you can see, it is moving in waves. So during the retracement, they try to find an area over here, right, to buy from. Okay, so the market will come to that area and continue to move up. So that area becomes the other block, either the fair value gap, breakout block, mitigation block, right? All those kind of stuff, right? But there's one problem about this issue, like this system of trading. You don't know whether the market is going to reverse from that particular other block that you have marked, or whether the market is going to continue, right? So it makes the whole thing so subjective. Subjective in the sense that like you doubt a lot, right? You doubt a lot. You don't know whether the market is going to move up or the market is going to move down from the zone that you have marked. Okay, so you make the whole thing so subjective. All right. So what side came into the game and did was that you don't have to be looking for an entry within the leg that did the higher high or within the leg that did the break of structure. You don't have to be looking for a zone there, an area there, other block, mitigation block, all those stuff. You don't have to be looking for them, right? All that you have to wait for is that you have to wait for the market to do the first leg, that is to do the higher high, okay, to do the indication. That is what you call the indication, indication, right? So the break of structure is what you call the indication, or the higher high that is going to form is what you call the indication. Now, why do you call it indication? We call it indication in the sense that you see over here there were sellers, right? There were sellers. Sellers were able to move the price from here to the bottom over here. I'll go to the chart and show you some rare examples, but let's focus on this one for a little bit. After that, you go to the chart. Sellers were over here and they were able to move the market down a little bit from here to here, right? So after the sellers moved the market down from here to here, now the buyers came in and they moved the market from this place to this place. Okay, now the sellers over here could not defend their position. Okay, they couldn't defend their position. So now they have been taken out by the buyers. If they defended their position, the market structure would have been like this, right? So it would have come here and did something like this. Okay, so you can see that the sellers that sold over here, they came back and they sold over here. So they defended their position. Okay. But since they couldn't defend their position, the buyers took them out. So this is an indication that the sellers has been taken out. The sellers, they ran away. This is an indication that the sellers has been taken out. Okay. They ran away. They couldn't defend their position. They are cowards. Okay. Now, after the indication, you wait for a correction. A correction. All right. You know the market moves in waves, like I said, so there will definitely be a correction. And wait for the market to come down below the zone of what? The zone that the sellers were already at. The zone that came as an indication or the indicating zone, right? The correction must come below it like this. Right? After the correction has come below the zone, you go to the next step. That is the continuation. You wait for the market to come back above the what? The zone of indication. So this area over here. And after that, this is where you enter the market. Now, so it says that you don't have to wait for a close. Okay, you don't have to wait for a close of a candle or something of that sort, because by the time that you do that, that will, maybe a lot of the move might have already been gone. So when a market comes above that area, you just click the sell or the buy button, or you put a limit order over there, like a stop order or something of that sort. All right. Then after that, you enter here, you put your stop loss below the low of the correction. Then you go to the next draw of liquidity, or the next area where you can see sellers. So that is basically what ICC. If you want to learn more, you can check out size channel, and check out size channel. It's trade by side. Let me open a new trade by side. You can type it on YouTube and it's going to give it to you, right? Trade by side. Okay, I'll check it out for you. It's loading. The network is not very fast. Pardon me for that. Trade by side. Yeah, this guy, you can see that he has a video here. Because I watch his videos a lot of times, YouTube recommends him most of the time in my feed. So this guy, trade by side, and he does a very good job in providing, trading knowledge for free, and also helping people to understand market strategy and stuff. So you can check him out and watch some of the videos to understand better ICC, all right, before you come here, so that we can continue with CCT. But if you understand the ICC, like I've explained over here, then you can continue with the CCT, and what you're come to do. So that's basically ICC, right? Now, what you have to realize is that in ICC, you have to identify the market structure, right? You have to identify the market structure, whether higher highs or higher lows, so that you can be able to mark your indication very well and your correction very well. That's one thing that you have to understand. And most of the time, identify the market structure is a little bit subjective. Okay, it's a little bit subjective. It's not totally subjective, but it's a little bit subjective. When you say something is a little bit subjective, it means there are a lot of doubts, right? It's not very clear. There are a lot of doubts. It's not mechanical. Okay, something mechanical says that when it is A, it is A. When it is B, it is B. But something subjective is like, at this point, it can be A, it can be B, subjected to a lot of opinions from other people, right? So if you look at the chart over here, you can see that this high that is sitting right there was broken. Okay, so that is an indication that the high has gotten broken. So at this point, you can wait for a correction from here to here. Okay, so below the low of indication, then you can look for what? You can look for a continuation, right? So you enter the market from here, then you put your stop loss below this low, then you target any area of demand, any area of supply that is from here to here, right? So that is going to be what you're supposed to do. So that is basically what site teaches, okay? And the next thing that you have to understand is very simple. Let me delete these things. The next thing that you have to understand is very simple. Being able to determine the market strategy is very, very important in this system, as you'll not be able to mark the indication or the correction and the continuation clearly, right? So for instance, if you mark this one as indication, this low that got broken as indication to the downward side and waited for the correction, this should have been the correction, but the market didn't come, below the indication for you to take the trade. So this one would have been very, I want to show you one scenario. All right, we will get some as we move along. Let me hide the session indicator. You'll get more as you move along, right? But that's basically what you have to understand, that you need to be able to get the market structure to understand the indication, correction, and continuation. Then CCT. Let's talk about CCT, candle continuation theory, right? Candle continuation theory. Candle continuation theory. right? So it simply means that when a candle closes bearish, it can also close bullish. All right. Sorry. It simply means that when a candle closes bearish, the next candle that is going to follow through is also what? Bearish. And when a candle closes bullish, the next candle that is also going to follow through is also what? Bullish. So that helps you to introduce some kind of mechanical framework or objectiveness inside your what? Trading. Like I said, objectiveness doesn't allow for a lot of what? A lot of that. It shows you what you're supposed to do when you see this, when you're supposed to do when what you're supposed to do when you see, A or B, and when you're supposed to what do it. All right. So introducing some kind of objectiveness inside our trading um, strategy or our trading system can help us a lot because it removes a lot of guesswork, right? There should be some kind of guesswork in trading, right? But the guesswork should be around like 20%, and the objectiveness, the framework, the building blocks, the the skeleton of the strategy should be about 80% because that is what actually is going to determine whether a strategy is solid or is just based on what speculations, right? So CCT is going to help us to what? It's going to help us to identify the market structure. That's us, looking at this one and say that okay, I don't know whether the high of this market is this one, or the high is this one, or the high is what this one. Obviously, the high is this one, but you can say that this one is too far. You might not be able to what to determine it. If somebody can also look at it and say that okay, the high is this one, and from this area we have a demand zone over here, and the market will come for this demand zone before it drops. You don't know that, right? So using CCT, we can actually what? We can actually be able to determine the market structure. And there are many variations of what? CCT. There are several variations of CCT that a lot of people teach on YouTube. I'd like to show you the difference between those kind of CCT and the CCT that I'll be teaching you. Okay. Now let me show you a very simple example over here. Hope I find one. It's the same indication, correction, and continuation, but they try to find a mechanical way by which you can identify them. All right. So let's take this one in consider to consider, right? So this area, this zone over here, you see this three bearish candle that dropped from this one, and this one. So one, two, three. Okay. Now the low of this candle, let's mark the low of that candle. Sorry. The low of this candle sitting right here. Okay. So you see the low of this candle got taken, right? The low of this candle, the previous candle got taken. So that is an indication that below this level or below this line, we are what? We are going to go bearish, right? Now, when you go to the lower time frame, you will see the market structure boarding like that. Okay, you see the market structure boarding like that. I'll go to the lower time frame, you are on the 1 hour. I'll go to the 5 minutes to show you. So from here, we have the indication. This bearish candle gave us the indication. Then the next candle gave us the correction and also the continuation. Okay, so let me mark the zone and go to the lower time frame and show you very well. Sometimes trading view, you go to the lower time frame and you miss the area that you're doing the analysis on. Okay, it's this area. So trading view should give us the option to go back to where you are already doing the analysis. MetaTrader has that and that types of. So this is the low of the candle that got broken by the big bearish candle. So you can see that one was the what was the indication. Okay, indication, right? So that's the end of that big bearish candle. Let me increase it. The end of that big bearish candle was this area, right? That was the low that it made, right? And the next candle that came traded up, right, into this zone. So that is the correction, right? And the continuation that came was from this area, this zone what to this area. That is the what? That is the continuation. Okay, so from here you could have entered here, when this bearish candle closed, you could have entered here, place your stop loss over here and targeted an easy what? 1:2. Okay, or 1:3, whatever would have worked. But make sure you put your stop loss to break even when the market moves away from your entry so that it doesn't reverse on you when you are in good profit. That's experience. I've done that a lot of times. And so that's basically the first variation of what? Of CCT, right? Candle continuation theory. But one thing that you also have to notice that a lot of people get frustrated by is the fact that you see it is not always the case that when you have a candle close below the low of the other candle to cause the indication that the next candle is going to trade inside the level of indication and come back. Okay, so for instance, we have this bullish candle over here. This bullish candle closed above the high of this bullish candle, causing an indication. So this would have been the area of indication, right? Somewhere here, right? That above this level, the sellers have been taken out, like we thought about the right. Yeah, 7. That above this level you are bullish. You are bullish. So at this point, you're expecting a retracement inside what this zone, right? Then a continuation. But you see that the retracement never came. The market what kept moving up. Okay, and this happens a lot of time, and people get frustrated and they don't know what to do. So my variation of candle continuation theory or CCT tends to what? Tends to cater for this thing. Okay, when the market is very bullish or the market is very bearish, you can still what? Get an entry. You can still get an entry. So that's basically what I'll be showing you over here. So what you have to notice is that you see after this candle closed bullish, the next candle that came was also what? Bullish. So my variation of CCT says that after this candle has closed bullish, expect the next candle to be what? Bullish. So the next candle that will be bullish and we have gotten the entry over here to trade what? Higher. All right. So that much I do. Let's get straight into what you are supposed to do. The rules of what? The rules of CCT, the candle continuation theory. Like I said, there are variations of candle continuation theory. There are two variations mostly. But people have way by which they trade yes, right? The first variation has its own rules. You can go and check out, I've forgotten the name of the guy who teaches it on YouTube, but you can just check it on YouTube, CCT, and I'm going to get his videos. I think he's the only guy that talks a lot about CCT. You know him. He talks very slow, so you know him. So let me go to the 4 hour time frame and with the daily time frame or the weekly. Let me delete this thing. All right. So the rules of CCT or the CCT that I trade says that the CCT that I trade says that I posted the rules here. When you go to my channel, you check the post, right? Community post, and you're going to find the rules over here. So let's use this one to explain it. All right. So the first one is if a candle closes above the close of the previous candle, the next candle that is going to form might be in the same direction. The word is might, right? Might. It didn't say will be in the same direction, might be in the same direction. Now there are rules that you have to follow to determine whether it is actually going to be in the same direction or not, right? So if you follow those rules, it's going to help you. Yeah. So let's look at examples of this rule and see if you're going to get it right. So if you check this area over here, I have to zoom in, zoom in, zoom in, zoom in, zoom in. Right. So you see this candle close bullish over here. The next candle close bullish. The next candle close bullish. The next candle close bearish. The next candle close bullish. We didn't get another bullish candle. Then this big bearish what drop. Okay. Now there are some rules that you have to also follow in order to know whether the next candle is going to be bullish or bearish, or to have the highest probability to know whether the next candle is going to be bullish or what bearish. Okay. Now the candle that is going to close from which you're going to expect the continuation must close above the close of the what of the previous candle, and this applies in both bullish and what bearish scenarios. All right, so without much talking, let me just show you. You see this candle, this big bullish candle over here, it closed above the close of this small bearish candle, way above the consolidation that were happening over here, right? So that close above the close of this candle tells us that at least The next candle that is going to come is going to be what? Bullish. Okay, so from here we expect the next candle to be bullish. Okay, note that we didn't wait for closing above this area was an indication. When you go to the lower time frame, closing above this area itself was an indication, right? Closing above the high of this area was an indication. We did not say that, okay, we are waiting for a whole correction to come down here before we are going to what? We are going to take the continuation up there. We do not do that, right? What we do is that we just jump to the lower time frame and we try to find an entry here, right? We try to find an entry here to continue the move what upward, because we know that after this has happened, the next candle that is going to come might be what? Might be bullish. What you have to also understand is that if the next candle that is coming doesn't become bullish and it becomes bearish, based on some rules that you're also going to define on the lower time frame, we are not going to be what? Stopped out. We are going to be safe, right? Sometimes you do get stopped out. Nothing is 100% in trading, so it's just the now instance of what? Of it. All right. No matter what you do, you get stopped out. So that is just the rule of the game. If you don't want to get stopped out, then you should stop trading, right? You should stop trading. So that's basically it. The candle that you are taking the continuation from should close above the close of the previous candle. And the same thing applies in a bearish scenario. You have this bearish candle over here. The next candle that came closed, below the close of the what? Of the previous candle. This is the close of the bearish candle. The next candle that came close below the close of the bearish candle. So you can expect the next candle that is going to come. That's this candle to be what? To be a continuation. Okay, so you could have gotten an entry over here on the lower time frame. I think I will go to the lower time frame in the next videos when I'm trying to show you how to enter the market and also analyze everything very well. Okay, so that's basically it. Right. There are some more how do you call it, more things that you also have to what? You also have to know, you also have to take into consideration, like where you are entering the market. I think one of the rules talked about that, and let me check whether this thing is recording. Yeah, it's recording. Nice. The rules we talk about is like I was saying. So let's move on to the next rule. And then the next rule talks about how to identify ranging markets and stay out of ranging markets. Okay, so it says that if a candle closes within the range of the previous candle, wait for any of the following conditions. And let me just show you the conditions. You can just go there and read, okay? But let me just show you the condition. You see, we have this example. Should I use? Yeah, we have this bullish candle over here. You see, this bullish candle closed above the opening of the bearish candle over here. So it tells us that, okay, we are probably changing direction to the upside what? To the upside side. Okay, so after this bullish candle has closed, we wait for the next candle to be what? Bullish. Okay, but the next candle that came wasn't bullish. It was what? Bearish. Like I said, you would have been saved. Okay, you would have been saved because of some rules that we are going to what? Identify on the lower time frame when we are entering the market, or maybe the market will have aim for your stop loss or break even or something of that sort. It is not 100% perfect, like I said, nothing is. But if you get a trade, it is very high risk reward ratio and it helps you a lot. All right. So the next candle that came was what? Was was bearish. But this bearish candle didn't close below the opening of this bullish candle, right? So it tells you that this bearish candle probably is not as strong. So at this point, we don't trade this bearish candle. It is just a consolidation. Okay, it is just a consolidation. Okay, the next, we wait for the next candle to also be bearish. If the next candle that comes also becomes bearish, then it tells you that maybe there's some kind of what? Strength in this bearish candle. So we should what? We should trade it, or you should continue expecting that the market is going to trade down like that. Okay, so that's something that you have to also take into consideration. But the next candle that came was bullish, right? And it was also within the range of this bearish candle. So this tells you when you have one candle being in the range of the other and another candle being in the range of the other, it tells you exactly what you're supposed to do. That the candles are consolidating. So at this point, you stay out and you wait for a rare break before you enter the market. Okay, I think that is clear, right? So if the candle closes in the range of the previous candle, don't trade, right? Wait for another close in the same what? In the same direction. Then you can expect that the continuation is going to what? Is going to follow. Because of that, other than that, just stay away and say that it is what? It's a consolidation and you're not going to get your hands dirty, right? It is confusing, but it's not actually confusing. Like I said, Like learn it a lot, okay? Learn it. Just go to the higher time frame and just try to predict the direction of the next candle by looking at how the previous candle formed, whether it was a consolidation, it was a close above the previous candle, and other factors that will come together later. And you're going to be able to master this. And after you've mastered this, it is going to introduce some kind of objectiveness inside your trading, because we are not going to say that I don't know whether the next candle is going to be bullish or bearish. You'll be expecting the next candle to be bullish or bearish based on what the previous candle has done. And it is also going to help you acquire some kind of discipline, because you are always going to follow what the trend is doing. Okay, if the trend is up, you're also going up. If it is down, you're also going down. You're not going to anticipate some kind of what reversals that are going to take your stop loss most of the time. Okay, now let's look at the third option. So we apply these rules only when we are in an area of supply or demand, or we are in between trends. Example, do not look for bullish signs when we are in a supply zone, coming from a supply zone and have not reached any significant demand. Okay, so let's take this one for instance. The market started coming from this area. This area is a demand zone, as you can see. If you don't know demand and supply, Google on YouTube. Why do I keep saying Google on YouTube? Just search on YouTube. Okay, YouTube is going to give you a lot of videos on demand and supply zones. Okay, so it's coming from a demand zone. A demand zone is just an area where sellers are. Okay, so sellers are here, they defended the position over here, right? So when the market came over here, they sold again. You can see that from this place to this place, they sold. Okay, and when the market tried to come above that area again, they also sold again. So sellers are here. So that's why you call it a supply zone, right? Did I say demand zone? It's a supply zone. Okay, so they sold again over here. So at this point, we are just looking at the fact that the candles that are going to form are going to continue in the same direction. If this candle is going to be bearish, the next candle is going to be bearish, the next candle is going to be bearish. All right. We are not looking for any bullish signs over here, because we are not yet in a demand zone. Okay, till we get into a demand zone, we are not looking for the candles to show us any pattern of what demand. If you see something like that, you just what ignore it, because it is noise, and it's going to what it's going to just mess your trade up or take your stop loss, something of that sort. So till we came to this demand zone that is sitting right here, or the areas are where buyers are, we weren't looking for any sells. All that we were looking for were buys. Okay, so when the market moved from here to here, that is the only time that you can be expecting you can be expecting some kind of bullish what signs. When the market came to this bullish zone over here and closed higher here, it closed in a bullish format over here, you could be expecting the next candle to be what? To be bullish, because of the fact that you are in a demand zone. And also because of the fact that we took liquidity from the low of this candle. I don't want to make this thing so complicated. I think I've learned it so much that it it has become normal with me, but it might be so confusing to you. All right. But if you master it or just look at it every day, I've been looking at charts for a long time, right? So these things are just easy peasy. But if you haven't been looking at charts and you don't have any experience with reading market structure, then you should spend a lot of time on the chart, and it's going to help you. Okay. So the market took the low of this, bearish candle over here. So you can expect even then that the market is going to watch bullish after this bullish candle over here. So the candle continuation is saying that, okay, now that you're in a bullish zone, or you are in a demand zone, and we have this bullish candle over here, you can now expect the next candle to be what? Bullish. And that is what? This one. Okay. And after this bullish candle, expect the next candle to also be what? Bullish. You can see that didn't happen, but it didn't close below the open of what? Of the bullish candle over here. So at that point, we don't expect the next candle to be what? Bearish. We expect some kind of what? Consolidation. And overall, we are not even in a supply zone. So trying to even trade this bearish candle is not high probability. It's just noise in the market. It's going to make you lose a lot of money. So we just don't trade it. We wait for another bullish candle like this one. Then you can expect the next candle to be what? Bullish, and continue in that order. So we get to the next area of what? Supply, you know, here. Then before you be looking for some kind of bearish signs and those kind of stuff, right? That's one thing that you have to be taken into consideration. Yeah, and everything that you have to know, everything that's like exiting the market and I'll share with you my experiences and everything. But for now, you have to be able to master the rules that is involved in the market structure reading, because at that point you'll be good enough for us to move on to the lower time frame to catch entries over there. When you start getting the entries, dude, it's going to blow your mind, because we are going to talk about tight stops and targeting 1:5, targeting 1:7, those kind of stuff. I don't like 1:2, 1:3. I think it's for people who don't have any balls. Okay. Yeah, so that is going to be all for this video. If you have any question, you can leave it in the comment section. I'm going to come and answer you. If you don't have any question too, then go practice what you've learned over here. First candle close above the close of the previous candle. The next candle is going to continue in the same direction. So far as we are not in a zone of what? Resistance. Okay, when you're in a zone of resistance or support, you expect the opposite. Okay, till we get a very huge break, a very huge disrespect. Maybe a candle came from, what is that? Oh, a candle came from, until you see a candle come from this area and disrespect all the demand zone over here, then you can expect maybe the next candle to also be bearish and continue in the same direction. Other than that, since we are in a demand zone over here, we just say that okay, we are just going to change direction and move on in the opposite direction. All right. And when you go to the lower time frame, that's where we are going to apply the ICC concept, and we are going to try to get a lot of trades over here. All right. So that is going to be all for this video. Learn and have fun. Bye.